Well, thank you for that, Cleve. We really appreciate it. I think that we've got a lot to really discuss with what's going on today in the market. So, previous to this week, we saw an improvement in interest rates. The bond market rallied even after the Fed made the Fed increase. We saw an increase in the bond market, which was a decrease in interest rates, and it was fantastic. We actually saw a little break in the action. Now this week, not so great. Okay, several rate increases, several alert to locks throughout the week. So we really did experience a less than attractive week. So let's talk about really the elephant in the room. We know interest rates are rising. Nobody's calling up and going, wow, that's a great rate. But let's put it in perspective. Over the last 40 years, the average interest rate is right around 7.4 to 7.6%. So let's call it 7.5%. Now, we've been spoiled because we saw rates in the 2s and the 3s and the 4s and the 5s, and now we're seeing the 5s gone and we're in the 6s, okay? And we're going to be in the 7s, and in some cases, if your credit scores aren't exemplary, then you may even be in the 7s, okay? So challenging credit scores, you may be in the 7s. I think it's going to continue to go up. Probably see 7.5%, maybe even 8% before this thing stops. But it will stop at some point. So now, do we sit on the sidelines and let things go by and just wait it out? Because there's a lot of people really thinking, let's just wait it out and see what happens. Well, I want to put this in perspective because I do the math on that. And, I thought maybe this is an opportunity to just take a break, take the summer off and see what happens. But then I started to look at the real numbers, and the numbers are the facts. Emotion is not factual. And a lot of people go, oh my God, interest rates are up, housing prices are up, so why would I want to buy? Well, we always are going to have housing prices up. If housing prices are down, we're in big trouble. They're not down. And how much are they up? They're up by over 15% already this year. And we've seen a pullback. So we're not at 23% like we were. Now, I expect, and I think Cleve would agree with me on this, that we're going to wrap up this year probably up around 10% from last year. So I think that's more than healthy. I mean, you have to remember a traditional consistent appreciation in value is 3 to 4%. So 3 to 4%. Now we see a little bit better than that typically in Florida than most other states, but a national average is 3 to 4%. So if we're going to see 10%, is it worth it? Or should we just sit on the sidelines? Even if rates are 7%, even if rates are 8%, let's look at the numbers on that. Now, for the first-time home buyer or the person that's struggling to get into a house, higher interest rates are definitely going to impact you negatively. There's no question about it. They absolutely are. But let's look at what are the alternatives? Well, you could rent. So now we all know what's going on in rent because every day I turn on the news and all they're talking about is rent control because rents are outrageous right now. But you have to put that in perspective too. Why have rents gone up so much? Well, there's a shortage of property, and that is basic economics, supply and demand. If there's not enough properties, then the prices are going to go up. But there's other reasons. Their taxes have gone up. Homeowners insurance has doubled and sometimes tripled for landlords and for homeowners that are living in their house. So all of these things combined add up to the landlords having to raise their prices. If their insurance went up by 100% and the law were to limit landlords to only increasing by 5%, well, that would be at a disadvantage for investors. Then what happens is they pull out of the market. You just look at these rent control markets, investors pulled out of the market and there was less properties available, not more. So unless the government wants to step in and just build housing for people that you can live in, then the problem is not going to go away. The solution to rent control is a 30-year fixed rate mortgage. That's the solution. Get a 30-year fixed rate mortgage. But let me get back on track. So interest rates are up. It makes it harder for the first-time home buyer. But is it worth waiting? So when we put all this in perspective, guys, and just you do the math, okay? Let's just say our average, because our median sales price right now is around $390,000. Let's just call it $400,000 because it's easier to do the numbers on that. And If your house goes up by just 5%, not 10, not 15 that we're seeing right now, not 23 that we saw in the last 3 years, but just 5%, you make $20,000 per year in equity, $20,000 per year in equity. So who cares if the interest rate is 8%, provided you still qualify, or 7% or 6%? And I'm not quoting you 8%. I'm just telling you it could go there. But I'm telling you, don't wait, because the housing market will continue to go up, and it might slow from 10% to 5%. It doesn't matter. 5% is great. You'll do great. You'll make $20,000 a year versus renting or staying out of the market and not making any money, because you're paying your landlord to do that. And when you look at the average 2-bedroom, 2-bath home in Orlando that's renting for $2,100, and you're just waiting just 12 months, you're up to, that's $25,000 that you just gave the landlord, and you have nothing to show for it. Nothing to show for it. And you're in a 2-bedroom apartment. Okay? That's what you got to show for it. So if you were to spend 25 where you could have made 20, and if it's at 10%, you'd have made 40. And if it's at 15%, you'd have made 50. So you put the math together, but let's just say you made 5% appreciation. That you would have made 20 grand instead of losing 25. That's a net gain of $50,000 in 1 year. It makes no sense to stay out of the market. Now, people might say, well, the interest rates are high and my payment's going to be a lot higher. You're right. Payment's going to be a lot higher. So is your insurance. Okay? It's going to all be higher. You're right. Now, interest rates are going to drop. They're going to come back down again. I don't know when. You could ask me, but I don't know. It might be 6 months. I think we're going to be over the curve probably in November or December. Because if you look at charts, you're going to see that we should be over the curve for inflation by the end of November. It might last till March. There's no telling. But we'll start improving. But is it worth it to refinance? No. I'm going to tell you that everyone I'm doing a mortgage for right now, including the 2 mortgages that I just closed on, I will refinance. I'm going to refinance them. Some people may say, well, it's expensive to refinance. Well, you know what? It does cost money to refinance. It might be $3,000, $4,000, $5,000 if you have to put escrows back in there. It might be even $9,000. I don't know. But if you can take the number that it costs you to refinance in closing costs alone, not escrows. We don't count escrows because it's still your money. It's taxes and insurance that you have to pay. But we take the cost of the loan. We take the improvement in payment. So let's just say we went from a 7% interest rate to a 4.5%. And let's just say that payment equates to $300. Okay? Let's just say it's $300. But it cost you $5,500 to refinance. $5,500 divided by 300 is 18.33. Now, what does that represent? How many months it takes to break even. Now, would you refinance to save $300 even though it took you 18 months to break even? Of course you would. Anybody in their right mind would. Unless you said, no, I'm only going to stay in the house for 12 months. Well, then don't. I'm only going to stay in the house for 18 months. Then don't. But if you're going to stay in there 2 years or more, then yes, it makes sense. So I use that barometer for myself. Okay. I know that a 36-month break-even period is beneficial. You get longer than that, then it really depends on the particular client. Are you going to stay in that house for a long period of time? I might go to 40 months. I might go to 45. You start going over 45, I'm telling you, don't refi. Just don't do it. And right now, believe it or not, I don't know why, but I'm still doing a bunch of refis for people that need to cash out, debt consolidation, divorce situations. They're still happening. So I'm there to help you with that. You have questions for the loan arranger? Listen, I'm always here to help you and your family. I promise you a straight answer. No sales pitch ever from me. You'll get the straight answer. 407-250-9144. It's 407-250-9144 for the loan arranger. 33 years in the mortgage business, closed over 10,000 transactions. And I'm going to be the sponsor of the All-Star Jam on September the 4th at Additions. And if you want tickets to that, I think I might be able to hook you up. I'll be back in 5 minutes with more of the Loveland Report and the Loan Arranger Radio Show with Bruce Woodburn, CrossCountry Mortgage, 407-250-9144, or WeBringYouHome.com, or Cleve Loveland at 407-352-8118. Stay tuned.